Lyft reported disappointing fourth quarter fiscal year 2022 results. It had the stock down as much as 35% on the day after these results were announced. So let's take a look at the figures and try and understand why the market hated what Lyft had to say about its fourth quarter results. To me, it seems like the business gets worse the more it grows because it's just not built on a sound foundation. Organic revenue increased by 21% in the fourth quarter to 1.2 billion. However, the net loss of 588 million worsened from a net loss of 283 million in the fourth quarter of 2021. So revenue grew by 20%, but the net profits got worse, more than double as bad as they were last year. So they lost 283 million in the same quarter last year. The same quarter this year they lost 588 million on the bottom line. It's just too expensive for them to provide right to consumers because they have to pay the drivers and all of their other costs, and they're not charging enough to customers to make up for those costs. And so the only way to get, well, not the only way, but one of the only ways to get the business on sound footing is to increase prices. But then they're worried that that's going to reduce customer demand, and those customers are going to go over to Uber or somebody else who's going to offer those services at lower prices, and they don't want to lose those customers. So it's just in my opinion not a good business to be in, and it's just the evidence is coming out as we get the as this industry matures. The evidence is increasing that there may only be room for one player in this industry that can survive and that can operate profitably, and even that remains to be seen. Active riders increased by 8.7% from the same quarter last year. So now they have 20.35 active riders. That's to be understood, right? The economic reopening is gaining momentum. More people are getting out, more mobile, going out to restaurants and things like that. Revenue per active rider increased by 11.5% to $57.72. This is good news. This is the metric that they need to continue increasing. In my opinion, they need to raise prices, and they need to accept the fact that they might lose some customers as a result of raising prices. The cash flow from operations worsened to a negative 237 million in 2022 from 102 million in 2021. So they're just losing more money as they're increasing their revenue and increasing their customers. However, they do have 1.8 billion dollars in their balance sheet in cash and equivalents, and this suggests plenty of liquidity. This is another reason why I'm so bearish on the industry overall, because all of the players, not just Lyft, they've got robust. Uber's got even more billions in cash, right? So and Lyft only lost 200 million in 2022 compared to 1.8 billion of cash. So it can go on at this rate of losses for another 7, 8, maybe 9 years before it needs to really tighten its belt and say, okay, maybe we do need to raise prices so that we can operate on a sustainable footing. And Uber's in the same position. Uber's got billions of cash. They don't need to tighten their belts and raise prices and operate more efficiently in order to sustain a business, put it on more sustainable footing. So this can go on for several years, and it's really just not a good place. If you're an investor looking at an industry to invest in, I would say stay away from rideshare and food delivery. There are better industries to invest in. Lyft is forecasting revenue of 975 million in Q1. So sequentially, that's going to be down from the fourth quarter, and it really raises the question on what's going on here with Lyft. Uber had better results to report. Uber stock fared better than Lyft following this report. Uber's more international. Lyft is, just specifically domestic and just specifically rideshare. So that could explain why it's doing worse. But overall, stay away from Lyft stock. You can understand why the stock was down 35% following these earnings results. If you'd been following my channel, I had made a video to start the year saying that Lyft stock was not a buy for 2023. Even though the stock is down following these results by over 30%, I still suggest to stay away from Lyft stock in 2023. The stock is not a buy. The lower price is not a bargain. It should be lower, so stay away. Uh, don't go anywhere near Lyft stock for now. All right. As always, I appreciate your viewership. Thank you for tuning into this video. I hope to see you next time for another one of my videos. And if so, I'll see you then. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.